Ideas are always there in the mind of human beings, but the challenge lies in how you put your ideas into implement. Venture capitalists are the people who help you to put your ideas into implement. Now the question arises, what is venture capital? Venture capital is a financial capital provided to early-stage, high-potential growth startup companies. Venture capital fund earns the money by owning equity in the companies it invests in, which usually have novel technology or business model in high-technology industries such as biotechnology and IT. In addition to angel investing, equity crowdfunding, and other seed funding options, venture capital is an attractive option for the new companies with a limited operating history that are too small to raise capital from the public market and have not reached to a state where they can secure a bank loan or complete debt offering. In exchange of the high risk the venture capitalists assume by investing in the smaller and less mature companies, venture capitalists usually get a significant control over the company's decision and significant portion of the company's ownership. Obtaining venture capital is substantially different from raising debt or loan. The lenders have a legal right to the interest on loan and repayment of capital irrespective of the success or failure of the business. The venture capital is invested in exchange for the equity stake in the business. The return of the venture capitalist as a shareholder depends on the growth and profitability of the business. This return is generally earned when the venture capitalist exits by selling its shares when the business is sold to another owner. Venture capitalists are typically very selective in deciding what to invest in. As a result, the firms are looking for extremely rare yet sought after qualities such as innovative technology, potential for the rapid growth, a well-developed business model, and impressive management team. Of all these qualities, the funds are most interested in ventures with exceptionally high growth potential, as only such opportunities are capable of providing financial returns and successful exit with the required time frame that venture capitalists expect. Because the investments are illiquid and require extended time period to harvest, the venture capitalists are expected to look about the business and the person with whom they are signing the contract. Venture capitalists are also expected to nurture the company in which it invests in order to increase the likelihood of reaching to the IPO stage when the valuations are favorable. This need for high returns makes the venture funding an expensive capital resource for the companies and most suitable for the business having large upfront capital requirements in which cannot be financed by cheaper alternatives such as debt. That is most commonly in the case of intangible assets such as software and other intellectual properties whose value is unproven in the turn. This explains why venture capital is most prevalent in the fast-growing technology and life science and biotechnology field. If the company does not have qualities of the venture capitalist seek, including a solid business plan, a good management team, investment and passion from the founders, a good potential to exit the investment before the end of the funding cycle, and the target minimum returns in excess of the 40% per year, it will find it easier to raise venture capital. It is considered as a setup stage where a person or a venture approaches to the investor in the venture capital firm for funding their idea about the product the firm has thought of. During this stage, the person or the venture has to convince the investor why the idea is worthwhile. The venture will invest into the technical and economical feasibility of the idea. In some cases, there is some sort of prototype of the idea that is not fully developed or tested. If the idea is not feasible at this stage and the investor does not see any potential in the idea, the investor will consider the financing the idea is not possible. However, if the idea is not directly feasible but a part of the idea is worthy of the further investigation, the investor may invest some time or money in the further investigation. If the idea is qualified for the further investigation, the process will go on to the startup stage. A business plan is presented by the venture to the venture capital firm. A management team is being formed to run the venture. If the company has a board of directors, a person from the venture capital firm will take seat of the board of directors. The prototype is being developed and fully tested. In some cases, clients are being attracted in the initial sales. The management team establishes a feasible production line to the product production. To prove that the assumptions of the investors are correct about the investment, the venture capital firm wants to see the result of the market research to see whether the market size is big enough, if there are enough customers to buy their product. They also want to create a realistic forecast of the investment needed to push the venture capital in the next stage. If this stage venture capital fund is not satisfied about the process or a result of the market research, the venture capital firm may stop funding. The venture will have to search for another investor. At this stage, we assume that the idea has been formed into the product and is being produced and sold. This is a first counter with the rest of the market and the competitors. The venture is trying to squeeze between the rest and it tries to get into the market from the competitors. This is one of the main goals at this stage. Another important point is the cost. The venture is trying to minimize their cost in order to attract customers. The management team has to handle very decisively. The venture capital firm monitors the management and capability of the team. This consists of how the management team manages the development process of the product and how they react to the competition. If at this stage the management team is to be proven their capability of understanding hold against the competition, the venture capital firm will probably give a go for the next stage. However, if the management team lacks in managing the company or does not succeed in competing with the competitors, the venture capital firm may suggest of reconstructing the management team and extend the stage by redoing the stage again. In case the venture is doing tremendously bad, whether it is caused by the management team or by the competition, the investor will cut off the investing. This stage is seen as the expansion or maturity phase of the previous stage. The venture tries to expand the market and share their gain to the previous stage. This can be also done by selling the amount of the product or having a good market campaign. Also, the venture will have to see whether it is possible to cut down the production cost or reconstruct the internal process. It becomes more visible by doing SWOT analysis. It is used to figure out the strengths, weaknesses, opportunities, and threats of the venture facing and how to deal with those problems. Apart from expanding, the venture also starts to invest follow-up products and services. In some cases, the venture investigates how to expand the life cycle of the existing firm's product or service. At this stage, the venture firm monitors objectively already mentioned in the second stage and also new objective mentioned. The venture firm will evaluate the management team has made expected reduction, and they also want to know how the venture competes against the competition. The new developed follow-up product will be evaluated to see if there is any potential. In general, this is the last stage of venture capital financing process. The main goal of this stage of the venture to go to the public so that the investors can exit the venture with the profit commensuration with the risk they have taken. At this stage, the venture achieves a certain amount of the market share. This gives the venture some opportunity, for example, merger with another company, keeping new companies away from the market, eliminate competitors. Internally, the venture has to examine their product's market position and if possible, reposition it in an attractive manner. This is also the phase of introduce the follow product or service to attract new clients and market. The venture have occasionally made very successful initial market impact and have been able to move into the third stage, directly exit stage. In these cases, however, they are unlikely that they will achieve the benchmark of the venture firm. There are basically 4 elements in financing the ventures which are studied in depth with the venture capitalists. These are management, the strength, expertise, and unity of the key people on the board bring significant credibility to the company. The members are to be mature and expert and experienced, possess working in knowledge of the business and capable of taking potential high risks. Potential for capital gain. The venture capitalists assume a great return from the venture. They have invested in the business and assuming a high risk, they assume a great return. Realistic financial requirement and projections. The venture capitalist requires a realistic view about the present health of the organization as well as the future projections regarding the scope and nature, the performance of the company in the terms of the scale of operations and operating profit and further costs related to the product development through research and development. Fourth, the owner's financial stake. The financial resources owned and committed by the entrepreneur in the business, including the funds invested by the family, friends, and relatives, play a variety of role in the business.